The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
An economic release, a sigh of relief, and the dip buyers reawaken. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Bonnie Quinn. We are kicking you off to the closing bell right here in the United States. So let's get a check on those markets, which have been up and down all week. 3 days of declines. Now you're seeing Friday with gains for the major indices. Now I left off the S&P 500 because the Nasdaq 100 is up 0.4%. Meanwhile, the small caps also doing well today, up 9/10% in fact now. So we're ending up with a nice rally here. The 2-year yield has been moving higher for most of the week. We're down just a basis point in the session, 364.50. And I wanted to point to oil because, in fact, we saw Brent jump above $70 a barrel. NYMEX crude still at 65.50. There are some barbs being thrown around, on the sidelines of the UN General Assembly that bring geopolitical tensions back to the fore. And also, of course, we have a potential shutdown looming as well next week. So lots on the calendar, Romaine.
Yeah, absolutely. We saw a lot of activity in the commodities space this week, from oil to copper, gold as well. In fact, this was a macro-driven week, and the latest macro data suggests that the U.S. economy is strong enough that it doesn't need those 2 Fed rate cuts by year end. At least that was the narrative all week long. A bit of a balancing act for the Fed to fight price growth and bolster job growth. A balancing act that, at least based on the PCE data this morning, the market thinks, well, maybe you put those 2 rate cuts back on the table.
I definitely think in the context of the last couple of months, the fog has started to lift. We're very much focused on trying to land the plane here and balancing inflation, unemployment, and the downside is limited.
And while today's data prompts a modest vibe shift, it's not enough to overcome the previous 3 days of losses. The S&P and Nasdaq still heading for what could be their first down week in 4. The small cap Russell ending a 7-week stretch of gains. But there is a silver lining out there, and it has to do with inflows. They're still solid. Bank of America strategists say $88 billion has been allocated to global equity funds in the past 2 weeks. That's the 3rd highest 2-week inflow ever. So maybe when you look at this week's pullback, it is just that, a healthy pause in what is an otherwise still a healthy bull market, a bull market that is now just 2 weeks and 2 calendar days away from its 3-year anniversary, which would rank it among the 10 longest bull runs since record keeping began back in 1928, Bonnie.
Amazing, although we've lived it, so not that amazing because we've seen it every day. I wanted to point to some of the data that Romaine mentioned. Obviously, a lot of it was positive. We had personal income a tick higher than expected, personal spending a tick higher than expected. And as you can see, for the last 2 years, we've really only had 4 down months in spending. And it was a particularly strong month in August for spending. Will it stay the case, though? It all will depend on the labour market and those wage gains. They are moderating, as we saw. We'll maybe hear more next Friday, although if the government shuts down, we won't be getting data next Friday. Remember last month when jobs numbers were out and the website wasn't working and it came back online really fast? Well, that could happen, but the website might not come back so fast this time, Romaine.
All right, well, let's focus in on the here and now with Diane Swonk, chief economist over at KPMG. And Diane, I do want to start with the PCE data this morning. Incomes elevated, spending still going, and inflation still high, but still relatively contained.
Exactly. And I think one of the most important issues is how strong spending has been and who's carrying spending. We saw much more broad-based gains in consumer spending this month than last month. We knew that a little bit from what we had seen from the initial retail sales data, but there is a real break going on. What we're seeing is the strength is coming from the top 20% of households, while the bottom 80% of households are stagnating. That's work that Moody's Analytics has done, but it really does show up also in the wealth inequalities that we've seen from the Federal Reserve. 67% of wealth in the country is held by less than 10% of households. So that really is a high concentration on those wealth effects. And I think it's important to look at that because what we're starting to see is some effects of tariffs, but the bulk of those effects are still ahead of us. All the effects of August tariff movement, that still has yet to hit, and we had that major front-running wave. Now, we did see discounting in things like furniture, appliances, computers. That has been going on. But once you strip those out and look at rest of goods, they were up at their fastest pace since 1991
I know
for a 1-month increase. We're also seeing services increase as well.
With regards to some of those, I guess the sort of delayed reaction, if you will, that we're kind of still waiting on to really see that feed through of the tariffs, do we have any sense of kind of a time frame from that? I know it's difficult to make that prediction, but we've been sort of waiting for this for months now, and we're heading into a holiday shopping season, and then, of course, coming into January, February, where I think a lot of people are going to take stock of what they bought the holiday shopping season.
Exactly. So we know that from history and all the research on tariffs, it can take up to 6 to 18 months for the full effects to show up. And remember, we had a lot of pauses in tariffs, and a lot of the additional tariffs just came in August. And we saw more introduced last night as well. How those actually settle out, what the carve-outs are going to be, we're still trying to figure that out. But those additional tariffs will be added on by year end. And so we'll start to see more effects by the end of this year. And then we hope to see them tapering off as we move into 2026. What's important is the first year of tariff revenues is the strongest year of tariff revenues because the whole point of tariffs is to discourage imports. And so as we go forward, you're not going to have the same revenues. And of course, some of the legal cases that the Supreme Court's going to hear in January will have an effect on what the tariff revenues, on whether or not they need to be reimbursed and refunded on some of those tariffs this year. But on the other side of it, the administration has made it very clear that they have other levers to push to reinstate them. And we're still waiting for that second shoe to drop. The rest of the world isn't waiting for us. Canada and the EU are looking to join the free trade agreement in Latin America, and Mexico has more free trade agreements than any other country out there.
Diane, why are wage gains moderating? So we know, obviously, that tariffs are having some kind of an impact on corporate America out there, but the Fed chair himself has called this a curious labor market where demand is going down, but supply is going down as well. And at the most recent FOMC, he mentioned AI and migration as having potentially more of an impact on the labor market than we maybe previously thought.
Yes, what we are seeing is that demand and supply, the break-evens on keeping the unemployment rate sort of stable now is somewhere between 30 and 60,000 jobs a month. And depending on how much curbs on immigration we see, could move into negative territory. That's sort of a cognitive dissonance to think that we could see a negative payroll print and that could hold the unemployment rate unchanged. The Fed has raised that issue as well because they're looking at the same data that we are. And I think that's important too. What we haven't seen yet is, in general, tariffs should be a one-time bump in price levels. They should not cause inflation. But there is this proximity, and you're seeing it in consumer surveys. Consumers are souring on both the job market, concerned about that, and on their concerns about inflation, and they're spontaneously bringing up 44% of consumers spontaneously without being asked in the consumer sentiment survey actually brought up tariffs as their concern. Yes. And that they're starting to see it. They may be actually blaming more on tariffs than tariffs deserve because there's other things pushing prices up, especially at the grocery store, but I think that's important.
UMich did show, though, inflation expectations coming down just a little bit. That has to be a salve to the Fed, right? Because they had been going up. So does this mean that, we can say definitively those inflation expectations are not unanchored or becoming unanchored?
We don't know yet, and actually it came down 1/10, but the longer-term expectations went up a little bit. So, there's a bit of a trade-off there. The Fed would like to see the longer-term expectations stay more anchored and not edge up, and they edged up even as the short-term expectations edged down. The bottom line is the Fed has been sort of hedging this sort of two-sided risk where, Powell has said there is no good trade-off anymore, and that is the hard place to be. The other issue is financial stability, and we're starting to see that creep into what, these stellar PE ratios that we see out there. This is really, like you talk about this bull market, but what you worry about is on the other side of it, are there any places where there could be financial instability risk, and the Fed is certainly starting to look at that as well, and especially in the private debt equity markets. I think that's going to be a place they look very closely.
All right, Diane, always a great conversation. Diane Swonk, chief economist over at KPMG, kicking us off to the close here on this Friday afternoon. When we come back, a sit down with one of the original sharks. Robert Herjavec joined us, the renowned business expert and a leading shark on ABC's Shark Tank. We're going to get his thoughts on entrepreneurism, tariffs, and just running a business overall.
And from dropping business knowledge to dropping beats. Grammy-nominated music producer and entrepreneur Steve Aoki joins the program to discuss the launch of his venture platform, Aoki Labs.
And as we swing into the weekend, a conversation with Chad Mumm, the executive producer of Netflix's Full Swing, the founder of Pro Shop. Golf is having a moment in pop culture, and a lot of it is because of him. That conversation coming up in just a bit. This is The Close on Bloomberg.
The S&P is set to snap its longest losing streak in a month following lukewarm inflation and sentiment data. Our next guest says relatively stable employment, steady consumer spending and solid economic growth make for, quote, a pretty healthy setup going into the fourth quarter. Joining us now, Anthony Saglimbene, Chief Market Strategist at Ameriprise Financial. So we say the longest losing streak, but honestly, Anthony, we've had 3 days of very small declines for the S&P 500 that we look to be reversing today. And September to now for the Mag 7, we've seen an 8.4% jump. Can this continue into the fourth quarter?
Yeah, I mean, entering the fourth quarter, as you mentioned, I mean, the economy is on very firm footing. Atlanta Fed GDP now is pointing to 3.9% for third quarter growth. Analysts expect S&P 500 earnings to grow by 8% for the third quarter. As you mentioned, big tech and AI is moving higher in September. And so I think the economy is sitting on very solid footing. Labor trends are slowing, but still on solid footing. And we saw today consumer spending and income is very solid. Even though their sentiment is weak, what they're doing is actually positive for the economy. So I think if we get good, solid third quarter earnings reports starting next month and big tech delivers on the expectations, then I think there's room for the S&P 500 and stocks to move higher in the fourth quarter.
But what does that good, solid earnings report look like in the fourth quarter? Because we've been trading on forecasts and capex spending forecasts in particular, and beats almost don't seem to matter at the moment. In Q4, if we start seeing those plans slow down, or companies perhaps just meeting as opposed to beating by a large margin, do we then see companies get punished?
Yeah, that's the risk. Obviously, CapEx spending has been very aggressive this year, and the companies that have reported in big tech, as they've reported, the law of large numbers is getting smaller. It's getting harder for these companies to really exceed analysts' expectations. But I think what we've seen over the course of the last couple months, and particularly after the last two earnings season, is if companies, especially in technology, can deliver on those earnings, which in aggregate, S&P 500 earnings are expected to grow for the information technology by 20%, which is very outsized relative to the rest of the market. And they can provide solid outlooks and show maybe some monetization on these AI and these CapEx investments. Then I think investors will continue to reward these stocks. But valuations are elevated, which means these companies have a lot to prove right now.
I am curious about on that last point, though, Anthony, because I mean, a lot of people have been talking about the spend and their ROI, or at least the lack thereof so far, with emphasis on so far. And David Einhorn, of course, sounding that alarm overnight at a conference, kind of talking about this idea that all these trillions we're putting into it, not everybody is going to see a return on that. And I know we go through these cycles before. We saw the same thing with the tech boom, way back when, and we've seen this with other big industrial cycles as well. But I wonder, as an investor, do you just sort of play this as the market as a whole, just sort of rising tide lifts all boats, or are you going to be very selective in picking those stocks that could potentially benefit the most from the AI trade?
Yeah, I think you have to be selective, and I think you have to be patient. And so the build out, or the infrastructure build of AI, is going to take many more years. And the companies and the hyperscalers like Microsoft and Alphabet and Meta that are building, Amazon, that are building these large infrastructures for other companies and other industries to tap into will take time. And so the monetization of that is likely several quarters out. But as these companies are making the investments, as they see more industries tap into the resources of AI and the infrastructure and the data centers, the opportunity for revenue to grow will be there. So I think it's very important for companies to provide that type of guidance and outlook for investors. And they're also going to have to rationalize some of this spending in terms of providing guidance for investors of what that monetization plan looks like. And right now, investors have been patient and willing to kind of look out into the future. As we get into next year, I would expect investors to want to see more detailed plans around the profitability, especially with the type of money that's being spent on these infrastructure systems.
Hey, Anthony, I do have to get your thoughts on something a lot more short term, and maybe it doesn't have an impact on the market. That is the budget fight in Washington, the potential for a government shutdown next week. I've seen some interesting data out there, including from folks over at Truist, kind of showing how in past government shutdowns, at least going back to the 70s, you didn't see a huge market reaction in either direction. I am curious as to what you're expecting or anticipating, assuming that we do get to October 1st and there is no government functioning.
Yeah, I think you'll see a little bit of volatility, which is what you typically do around government shutdowns right before, so that headlines are hitting, government shutdowns coming. So you see a little bit more of market volatility during that period. But it's interesting, over the last 4 government shutdowns, the S&P 500 has actually climbed higher during the shutdown period. And so what we've been advising to our clients and advisors is to look past the kind of the near-term noise around the government shutdown. If it goes on and extends into next week, there's a possibility we might not get a non-farms payroll report, particularly with employment so important to Fed policy and overall markets. That could be a little bit disruptive for the market, but we're going to get that report eventually. Republicans and Democrats will come together and we will get through this period. I think as an investor, you need to look through it.
Anthony, have a wonderful weekend. Got to leave it there. Anthony Saglimbene, Chief Market Strategist at Ameriprise Financial, of close eye on the markets, which are in the green. When we come back, we take a look at one of the names in the red, RH, the furniture retailer, down about 4% on the day on the back of the Trump administration threatening more furniture tariffs. A conversation with Brian Nagel over at Oppenheimer when we come back after the break. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with Kenvue. Rothschild Redburn upgrading the Tylenol maker to buy, seeing a, quote, clear path to value creation despite the unproven claims linking the over-the-counter painkiller to autism. The analyst also says that for now, the U.S. Health Department's related proposals on those allegations are a touch more measured than feared. Those shares up about 0.3%, though the stock dipped down about 11% this week. Warner Brothers Discovery, that's up next. KeyBank downgrading to sector weight amid concern that the stock's valuation has gotten ahead of fundamentals. The analysts also raising worry about the viability of a buyout by Paramount Skydance, which might be too expensive to pull off and could hit regulatory hurdles to boot. Those shares down a second day, but nevertheless still headed toward a 4th straight weekly gain. And finally, AppLovin, UBS, loving it, taking its price target to the street high $810 a share, up from $540. It's the firm's top pick, with the analysts expecting strong execution on demand and supply expansion initiatives to drive upside, and they have a pie-in-the-sky upside case of $1,000 a share. We should point out that stock on a 6-week win streak right now to a record high. Those are some of our top calls. We do want to turn now to one of the big decliners on the day, and that is RH, down more than 3% on the day after the Trump administration said that it would impose 50% tariffs on kitchen cabinets, bathroom vanities, and associated furniture items starting as soon as next week. Our next guest warned just last week that RH still faces tariff headwinds in the coming quarters. Brian Nagel joins us right now, senior analyst over at Oppenheimer. And Brian, we should also point out, management itself in that last earnings release also made it clear they were still worried about tariff concerns here. Do you have any way to quantify what the potential impact would be on RH if these new tariffs do go into effect?
Well, good afternoon. Thanks for having me on the show. No, look, it's very difficult to quantify, okay, because, I mean, there's some really big variables that remain. I mean, one, what ultimately happens, okay? And I think, I've been studying very closely as my coverage with RH and a lot of other names. My team and I have spent a lot of time studying tariffs over the past, several months now. And, what we're learning is there's just no clear path. The tariff communications from the administration change repeatedly. So, as I think about a direct impact to RH, what we learned maybe last night, that's still a variable. And then probably the more important variable is just to what degree these mitigation efforts, have effect. So what you hear most companies like RH saying, there's a collection of mitigation factors. One, vendor concessions. That means basically passing costs back along to manufacturing partners. 2, the company itself controlling costs to offset the cost of these tariffs. And then 3, and probably most importantly, retail price adjustments. And I think at the end of the day, that's really where most companies are going to lean, including RH. So maybe not immediately, but over time, they adjust retail prices to basically account for whatever tariffs may finally be put in place.
But they're so weirdly specific this time. I mean, upholstered goods, vanities. I mean, who even uses vanities anymore? Kitchen cabinets. Is there some kind of geopolitical reason for this? I mean, is he targeting IKEA? Is he targeting? It's just so strange, Brian.
Well, look, is there a reasoning? I don't really. I have no idea. Okay, but I mean, if I step back and say, okay, not just this discussion, but maybe the tariff discussion more broadly, I think the idea, or if there is a big focus, it's to get manufacturing back to the United States. Now, I've said repeatedly, and I've written and I've talked to our clients, and again, for the furniture category as well as other categories, I've used the term laughable. I mean, I just don't see manufacturing in any key categories coming back to the United States at all. I think that's it's really, there's significant limitations to that. But I think that if there's anything, that's probably the big push here.
Well, that's what I'm curious about, Brian. I mean, they've spoken, RH management has spoken about the idea, how they've tried to diversify their sourcing. It's still heavily overseas, but the idea is not just China, it's Vietnam, Bangladesh, all these places, and they make some stuff here, obviously, in the U.S. and North Carolina. When you look at RH, and for that matter, some of the other companies under your coverage, what optionality do they have to shift their production to other countries, not necessarily the U.S., but to other countries that, if not eliminates the tariff risk, at least minimizes it?
No, look, that's a great question. Okay, and in this regard, tariffs are not necessarily new. We saw under the prior Trump administration, tariffs. This was back in, I guess, 2018 or so. And so with that, with that round of tariffs now, which is a while ago, from my vantage point, a lot of manufacturing was moved out of China. And we saw manufacturing go from China to places like Vietnam, Cambodia, other Southeast Asian countries. And again, that wasn't just home furnishings, but I saw that in leisure and other categories, right? Yeah. Okay. The problem now is, is that there's tariffs across the board. So there really are no sort of safe havens geographically. These countries where they were able to garner, if you will, manufacturing from now have tariffs themselves. So it's very, very difficult for retailers and manufacturers to move to another country with tariffs alone. Yeah. Hey, Brian, got to leave it there. Up against a commercial. Have a wonderful weekend. Great research, as always, out of Brian Nagel, senior analyst over at Oppenheimer. This is The Close on Bloomberg. 3:30 p.m. here in New York City. This is the countdown to the close as we look out over that skyline. Bonnie Quinn, just a reminder that the United Nations General Assembly starting to wrap up. Still a lot of events going on over the next few days and even into next week. We are getting some headlines, though, out of some votes that the UN Security Council has been making. This involving Iran, effectively saying that the Iran sanctions, the relief from those sanctions that they had granted to Iran, that those now will be pulled back. That was a 6-month reprieve. That reprieve will not be extended beyond that 6-month period. Yeah, they were calling it the snapback. So the snapback now takes effect. In other words, the sanctions will snap back into place because Iran hasn't been the good actor that many countries wanted it to be. 4 countries voted for the resolution, 9 voted against and 2 abstained. And it was, of course, as we keep an eye on the UN, we're also keeping an eye on the markets, ending the week on a high note, despite it still is a rather tepid week. But a couple individual stories, Vonnie, that caught my eye. One on electronic arts. The shares have been halted a little bit earlier. They've now opened back up, rallying about 14% on the back of a Wall Street Journal report that it actually might be taken private. Yeah, this is a fascinating story. Wall Street Journal reporting that Affinity Partners is part of an investor group that are near a deal for electronic arts. Of course, you know, Silver Lake and the Saudi PIF were also part of it. Yeah, they're in everything. But this would be, you know, a major deal. It could be valued at as much as $50 billion. Yeah. And we should point out we have reached out to Electronic Arts for comment. They have not responded yet. And our reporters, of course, are all over this. A stock now up about 14% as we move closer to the closing bells. And when we talk of deals, I mean, who better to talk to than the folks
over at Shark Tank. Bonnie, you watch Shark Tank?
I have been known to stay up too late watching Shark Tank every now and then, yeah.
It's a fan favorite. And guess what? The inaugural Clover and Shark Tank Summit is actually going to kick off in Las Vegas this weekend. The speakers are going to include who else? Mark Cuban, Gary Vee. They're going to address a star-studded conference about the most important trends in small business and entrepreneurship. So a little bit earlier today, I had a chance to catch up with one of the OG Sharks, Robert Herjavec.
Did you pitch him?
To talk all that. I did not pitch him, but he pitched me on a lot, at least on his thoughts on AI and some of the other investments that he's keeping his eye on. Take a listen.
I think the market's been on fire, as we all know, in the last couple of years. I'm a big believer in infrastructure, non-sexy businesses. So one of my big investments was a company called CyberArk, which is identity on the internet. I'm a big believer, what's the old adage? People made more money selling picks and shovels during the gold rush than the amount of people that actually found gold. And I love infrastructure investments like that.
I mean, part of the infrastructure build out that we're seeing today certainly has a technological bent to it. Of course, with all of the hype and potential promise, we should say, around artificial intelligence. I'm curious, when you look at that and we talk about the picks and shovels idea behind that, do you think that what we're seeing right now in terms of the attention and the money being pumped into this is going to be commensurate with the potential return down the road?
Not for everybody. And that's a great question. What we're seeing right now is there's three phases to AI and most technology cycles. The first phase is the sexy phase, the consumerization of a new technology. Like when internet first came out, the number one application on the internet was sex. And then it quickly became communications. So today you've got all these consumer-facing AI bots and interfaces. The second phase will be the applications of it. And then the third phase is the data infrastructure part of it. So not everyone's going to survive, but I'm very bullish on companies like Databricks, Snowflake, a company that I'm invested in called Zetaris out of Australia, all in that space. Because no matter what AI does, it's always built on data, and you need the right data to take advantage of AI.
And I am curious, I mean, given your background in cybersecurity, I assume that also has to be a huge component of this as well.
For good and bad, right? Like everything with AI is moving at warp speed. So, a lot of people are talking about facial recognition, but AI models today can create this video we're watching from a single still photo. So there's lots of challenges, but also on the good part of it, you can also filter all that stuff out. It's going to be interesting times.
This comes on the eve of the Clover Shark Tank Summit, which is ostensibly a closer look at, I guess, how budding entrepreneurs can they be, I don't know, if not following your path, certainly the path of some of the other great entrepreneurs out there. What are you expecting this weekend?
Well, you said it right. I think people always say, I want to be like you. I think it's about giving people the skill set to be the best version of what they can be as an entrepreneur. So we're expecting a lot of people to come out and learn and see how we did it so they can apply it for themselves.
I mean, you've had a great career, and in a lot of ways you are emblematic, I think, of that sort of a startup dream, if you will. Do you think it's harder today, in this day and age in 2025, to try to start a business relative to what it was like when you were coming up?
Well, I think, first of all, 50% of all businesses fail in the first 3 years, and the ones that are remaining, 50% of those fail in the next 3. So I think it's really hard anytime to start a business. But today, right now, anybody listening, this is the best time in history to start a business. Why? The power of computing. Cloud computing gives everyone access to incredible power. AI is one of the greatest enablers in history. So now, I think it's a great time to start a business, but your value proposition has to be very high because everybody else can also start a business right now.
You've attached yourself, at least through Shark Tank, on several notable consumer products companies. Obviously, a lot of us know you for Tipsy Elves. I know that seems like many moons ago. But when you start to see these pitches from people, particularly in this day and age when you're dealing with higher input costs, higher tariff costs, and just a lot of economic uncertainty out there, what is the advice that you give those folks who are starting a consumer products company?
Consumers will always pay a premium for an experience. And yeah, tariffs are hard because there's a lot of instability. I mean, tariffs themselves aren't hard. It's the fact that you don't know what they're going to be. So good news, bad news, most entrepreneurs can deal with it, but the instability is hard. My advice to people is always, when you build a great community that connects with the consumer, people will follow you. And so your ability to raise prices, incorporate your cost for a product that touches consumers will never go away.
It's hard to believe, 17 seasons of Shark Tank. And you actually started before that. You were on, what was it, Dragon's Den, I guess when it was up there in Canada, coming out of Japan, and it got rebranded as Shark Tank. 17 years, and it's changed a lot. I mean, Mark Cuban's moved on. You're still there. You're one of the OGs, and you guys have got a lot of guest judges this year as well.
We do. We've got Kendra Scott, who is amazing, by the way. What a powerhouse woman she is. She runs a $1 billion jewelry retail business. Talk about a tough business. Man, she is killing it in there. We had Rashawn Williams, who's a big sports tech investment guy. And we have Michael Strahan from ABC's Good Morning America. And, you know, everybody knows him as a football player or a host. He was a great guest shark.
Yeah.
He knows his business.
And we talk about, of course, Shark Tank obviously airs on ABC, and of course it broadcasts to millions of people, but we see so many entrepreneurs these days actually cutting their teeth on social media, finding a way to sort of break through the noise and the fog, utilizing some of the most popular apps out there, including TikTok. We talked a lot about it this week. President Trump signing an executive order just a little while ago that, as he says, advances plans for American investors, primarily led by Oracle, to buy the U.S. operations of TikTok from its Chinese owner, ByteDance. Vice President J.D. Vance, who played a central role in crafting the deal, he said the transaction would value the new U.S. company at $14 billion. Mark Douglas joins us right now. He's the CEO of the ad tech platform Mountain. And I should just point out, Mark, too, $14 billion was way below, I think, what a lot of investors thought this would be valued at. Yeah. There's still a lot we don't know about this deal, and we still have to hear from the Chinese. But I am curious as to whether you see a viable reboot of TikTok under a U.S. umbrella.
Well, I think a lot depends on what the user experience is going to be. There's really two areas. One is, are you going to keep your existing TikTok app or somehow need to log into a new TikTok app and basically create a new account or transfer an account? I think that's one question that really hasn't been answered yet. And the second is, everyone's been so focused on where the data is. That's what this is about. I think there's not enough focus on where the revenue is. Like, are we going to continue to see the revenue flow in? And I think one thing that's really underestimated, to add one final point, is that a lot of revenue comes from TikTok Shop. A lot of influencers are not these big influencers getting big deals. They're people promoting products in TikTok Shop. It drives a lot of revenue for TikTok, a lot of revenue for those influencers, and thus a lot of engagement on the platform, which is critical.
I mean, you raise this whole issue about the idea of sort of what the actual monetization of all this, the value of it will be. And I'm curious, I mean, what was, I guess maybe let's reverse engineer this. I mean, what was kind of the secret sauce that made TikTok so sticky in terms of us watching it, but more importantly, the feed through, the idea that I wasn't just watching things, that I would actually click through and potentially buy something from a lot of the folks who are on there?
Yeah, so that's the thing that TikTok kind of figured out 2 years ago. So first, it was, having a feed of just highly engaged content built for me. It wasn't filled with my friends. It was basically filled with people I didn't know, influencers, others, and just kind of keeping me engaged. And then they figured out, well, if those same influencers, if they can scale their influence to products, then that could drive a lot of revenue. And that's what TikTok Shop is. And I haven't seen any mention of this, but this is like a big source of revenue for TikTok, and it's a big source of revenue for the influencers. If the influencers all of a sudden are not making money off TikTok Shop, they're not going to be very motivated to stay on this platform. And so I think these are big questions. I just think that the focus on where the data is like we're past that. But are people still, are the influencers still make money, which is what drives all the other people that use TikTok?
Yeah, I mean, the deal seems a little odd to me. Were we so desperate to get the algorithm that we were willing to give away, you know, ownership of the e-commerce, the advertising, that actually ByteDance would get 50% or potentially more of TikTok's US profit? Was it algorithm for that?
Well, I mean, it's more in terms of once you've built a user community of more than 1 billion people, that's obviously very valuable. I think this is one of the lower valuations on a community of 1 billion people. Remember, like WhatsApp sold for $19 billion. I might even have 10. It's either 19 or 29. Sorry, I don't remember. But you know, that's basically the point. Is that all of the focus now needs to go to how this thing is monetized, and most importantly, just keeping people engaged. We saw with Snap many years ago, like you can lose engagement what feels like literally overnight, and I don't think TikTok is necessarily immune from that if some of these things are handled poorly.
Yeah, I mean, who among this group of buyers do you think will be able to handle it the best, Mark? Will they sort of fight between each other as to who gets to control what and what the board decides?
Well, I mean, the buyers are a combination of public-private equity funds, so it's not them. And then Oracle is a hosting provider. I think that remains to be seen. Like who's the U.S. president of TikTok now? Maybe this was announced and I missed it in the last hour. But no. What's the management team? Only a handful of people have been in a position of guiding, you know, basically a social network at this scale. Yeah. I mean, at least TikTok remains motivated if they're getting a share of profit, but they haven't figured. There's still a lot to figure out. Is kind of the point. Yeah, and we should point out, based on Bloomberg reporting, we're actually talking not only just finding new management, but new employees as well. So this is almost like kind of building from the ground up. And that leads me to my question for you, Mark. Given your expertise and what you do, I mean, would you actually steer anybody to that app initially when it comes out, or would you say, you know, sit back, maybe wait a few weeks or even a few months to see how things go? Well, to give you an anecdotal data point, just the multi-hour, remember at the beginning of the year or late last year, TikTok went off the internet for, 12 hours. Yes. Just those 12 hours killed a ton of spend on TikTok because the I know basically influencers were really hurting because the advertisers, the moment they felt there was uncertainty, just like people don't like uncertainty in a stock, they don't like uncertainty in their revenue. And if they're counting on TikTok to drive revenue and all of a sudden it can be off the internet, yes. You know, even for 12 hours, a lot of companies pull back. And Mark, I think now that they're going to feel the same. Are you on TikTok, Mark? Say again? I said, are you on TikTok? As a user, my girlfriend is totally, she manages a social media influencer agency. She's on it all day. I'm more of an Instagram person myself. Oh, that's your excuse. Mark Douglas, Mountain CEO, thank you. This is Bloomberg.
Going back to that breaking news on Electronic Arts, it is our stock of the hour, up 15% on the back of a report by Bloomberg that it is in talks to be taken private by a consortium led by Silver Lake Management. Nora Mulinda joins us here in Studio 2. A $50 billion potential price tag on this thing, which would actually make it one of the biggest leverage buyouts ever.
Most definitely. I mean, this is a very massive deal that we're talking about here. Of course, this involves potentially Silver Lake Management as well as Saudi Arabia's public investment fund here. So, I mean, if we think about the gaming industry more broadly, it has been a bit troubled. So, I mean, you are really seeing a lot of the street rallying behind this stock. It's up for its highest level on record right now and its biggest daily gain since 2014. So more than a decade here. Seems as though the street is happy with this news.
Another take private. We'll see more of them, no doubt, before the end of the year. Nora, thank you so much. That is Bloomberg's Nora Mulinda. I just want to go back to, because I mean, since we have time, I mean, we talk about $50 billion, which seems high to me. I know where the stock's been trading. But we talk about Twitter. That was a $44 billion deal. And of course, probably the most famous leverage buyout of the modern era was RJR. And that was $31 billion. $50 billion. I mean, I know you're not a gamer. For a simple gaming company. Are you mad in person? I am curious about Twitch. I like to watch other people watch games. That's very weird, right? We'll be back in a moment. This is Bloomberg.
In in general, tariffs should be a one-time bump in price levels. They should not cause inflation. But there is this proximity, and you're seeing it in consumer surveys. Consumers are souring on both the job market, concerned about that, and on their concerns about inflation.
Diane Swonk over at KPMG kicked us off to the close, just about 50 minutes to go, and kicked us off, Bonnie, with a discussion about the health of the economy. And we got a lot of data this week, and I mean, I know she had a lot of caveats, a lot of asterisks, but so far the economy is still solid.
Exactly. The overall data shows an economy that is resilient, and we even got that upgrade to GDP yesterday. But Diane has for a long time talked about this K-shaped economy and how, you know, the lower percentages and those that are less well paid are just feeling it a lot harder than those with the wealth effect, which, as you can see by the stock market, they're getting richer every day.
Yeah, absolutely. We talk about the moves higher that we've seen here. I mean, obviously, this is just on the day. And we should point out, we are still down on the week, but this is almost a minor reset compared to the big run-up we've seen over the last 4, 5, 6, 7 weeks.
Minor reset because we are well up on the month. We're up more than 2% in the S&P 500 and more than 4% in the NASDAQ for the month to date. And this is September. This is supposed to be a month where we might see, you know, some down behavior. But right now, as you can see, we have the NASDAQ, which is trading up 0.33%. The Russell, which is up 1%. The VIX is all the way back down to 15.5. Not that, you know, I mean, that's not a huge move, but nevertheless, we were hitting 17 yesterday. 3 little days of a breather. The dip buyers come out.
Absolutely. Steve Sosnick joins us right now around the desk here in Studio 2. Chief Strategist at Interactive Brokers. And I do want to start there, Steve, with just market sentiment overall. I also was kind of interesting because I was kind of going back and looking at where we've gone in this market. And I kind of forgot, we're actually just a couple weeks away from the 3-year anniversary of the start of this bull market, assuming you go by the traditional metrics from that October low 3 years ago. And I know that's not the longest bull market by any stretch, but given all that's transpired, particularly this year, it's kind of surprising that we haven't had a meaningful and major correction or pullback to a bear market.
Yeah, but behavior of investors has changed. So all that you've said is correct, and I agree with it. But what happened was investors have been increasingly taught buy every dip, because it's worked. With the exception of a few months in 2022, it's been an essentially foolproof strategy. If people get used to a strategy that works pretty much all the time, they're going to keep doing it. And that's actually one of my theses, is the half-life of dips keeps getting shorter. That's why we don't even get these meaningful dips. This, you know, as you guys were saying before, we had 3 down days, but they were basically trivial in the scope of this market. And even yesterday, where we looked at one, like for a moment or two, like we had a bad down day, but we got down about 1% and up we went because that was a viable dip.
But that gets to the question as to what you see as the biggest risk, because there's been a lot of talk about this, the sort of bullish skew to this market, not only in stocks, but certainly in the option space. No one's really hedged. Everyone's selling puts. Everyone's going long on the dips here. And I'm wondering if this ends up being sort of the that sort of counterintuitive, that ultimately this bullishness in effect creates the potential for something bearish.
Well, actually, we saw it, you know, basically 1 year into the first Trump administration, when you had Volmageddon in 2018. Well, we're, you know, seven or 8 months in now, so we're not quite there yet. But you have the same sort of euphoria type of building in, where we're not at the extreme lows that we saw in volatility then. But I think again, the risk, I would say that the lack of fear is the thing I fear most, or, you know, the thing.
Yeah, no, exactly. And
that's very eloquent, by the way.
Yeah. You don't look too afraid. But Goldman Sachs, as we were talking about this earlier, yesterday, you know, John Marshall and his team talking about how October will be more volatile. It traditionally is. You're looking at potentially 20% more volatility and 450 catalysts between now and the end of the year, including things like the Victoria's Secret's fashion show, which could be an opportunity to buy volatility. That's a catalyst, according to Goldman. Yeah, I mean, you know, if there's a PR blub or whatever, you know. So what do you make of that? Are we in for more volatility?
Well, I prefer to focus on Victoria's Secret than a government shutdown next week, but that would probably be the first volatility. Next week, right there, you've got a potential government shutdown, and we have, you know, as you've seen the ads on your program, the forecast trader contracts, they're showing about 70% chance right now of a shutdown. So there's that out there. Markets don't react to that until they occur. We also have jobs numbers next week. There's always something, Bonnie, to your point. But I guess it's just a question of, can you roll off it? I think that, you know, the bigger existential questions, you know, remain out there. Can that can this love of all things AI just continue indefinitely?
Well, what about earnings? Because we have seen companies that give any glimmer of hope, rewarded tremendously. At some point, we're going to have to sort of go back to the 1% and 2% moves, right? Not the 6% and 7% and 10% moves.
You would think so. I mean, but this has been such a fluky year, right? Because the April earnings season came right after Liberation Day, and companies threw up their hands and said, I don't know what guidance is. And the companies, they weren't really particularly punished for it because they'd already been punished, so they got away with it. Then you flash forward to July, and as they reinstated guidance, they got rewarded for reinstating guidance as long as that guidance wasn't horrible. Well, now you've kind of gotten through that. So as we get into October earnings season, that can be a very big catalyst because now it's really about delivering and making sure that the guidance that they gave is something achievable and not just some number not just sort of relying on older numbers.
I want to get your thoughts just on risk appetite overall, and I want to look at it for a second through the lens of what's been going on in crypto this week. We've seen a big drop in prices, and there's been some data showing how all this buying for these treasury vehicles, if you will, these digital asset treasuries, had actually started to pull back last month, back in August. Yep. The pace basically slowing. And there's been some concern here that when we talk about risk appetite and we talk about maybe potentially bubbles, if I can use that word, that might have been one that we've been ignoring.
Well, fortunately, if a bubble or whatever it is, anomaly seems to be ebbing. I think you had all the MicroStrategy imitators, and it was basically anybody could go out there and say, I'm going to turn my company into a crypto treasury company. You're willing to pay me 2 times book, 3 times book for those cryptocurrencies that you could go out and buy from a coin dealer. By all means, I'm going to keep doing that, and that fortunately came to an ebb. But on the other hand, I saw your colleague Bailey reporting this morning that that SPACs are back, and that those kind of things. So they're all of the same variety of I'm going to ask you for money on the grounds that I'm going to do something interesting with it, and you're going to trust me. Yeah. That's very much of a bull market move, and it faded out even when money was free in 2021, and now there's a cost to money, and it's still going on in some ways, shapes, and forms.
We only got about 30 seconds left.
Sure.
Can I sell you on small caps right now, or are you still bearish on them?
I can't be outright bearish on them because the Russell 2000 fits neatly into Google and Microsoft. But so you can't short them. Yeah. But I don't love them because too many of them lose money, and the ones that do make money get bought up by private equity and leave the index anyway.
Steve Sosnick, Chief Strategist over at Interactive Brokers, helping us count you down to those closing bells, Vani, on a day where the Russell 2000 is actually outperforming.
Yeah, it's unbelievable. You have to wonder what the next AI trade is going to be. Is it going to be quantum? We've seen them on a huge tear. Yeah, we should point out the Russell's still underperforming on a weekly basis. All of the major indices here in the U.S. are going to finish the week in the red, barring a big change in the next 2 minutes. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Bonnie Quinn, taking you through to that closing bell on this Friday afternoon. It's a global simulcast. Carol Masser made it in for a 5th straight day. Tim Stenovic by her side. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A rare update.
Do you need some help there?
As of late, I'm a little verklempt. I was expecting a down day.
Only work 5 days or 4 days a week.
Yeah, I can do a 4 day.
How does this work, Tim? Are we allowed to object?
No, we have to be quiet.
Okay.
We have to be quiet until Carol and Romaine work it out. Okay. We just let them go for it.
Hey, listen, we're on track for a down week on the S&P 500 after 3 consecutive weeks of gains. So we've seen quite a pop to the upside. It feels like stocks overall have been taking a bit of a break, but there are individual gainers that have actually done pretty well.
We got some economic data in recent days that's made people feel kind of okay about where the U.S. economy is. I wonder if the payrolls report next week will change their mind. 50K is what the economists surveyed by Bloomberg are expecting. We'll be talking about that in about a week from now, and we'll see if that number gets revised as we get closer to that release.
I thought you were going to say we'll see if that number gets released.
I was just going to say, if that number is released.
If the government is still open. Yeah, exactly. Well, after 3 days of declines, they were very small declines, and it turns out, Romaine, that we are seeing an update to finish the week.
Yeah, and we talk about this being a macro-driven week, and of course, with concerns about a potential government shutdown, and of course, a big jobs report 1 week from today, that could be the driver of the market, particularly in the absence of any major corporate fundamental stories. We get green on the screen here on this Friday afternoon, though we should reiterate that on a weekly basis, all of the major U.S. indices are going to finish in the red for the week. For the S&P and the NASDAQ, that's basically ending a 3-week win streak. For the Russell 2000, a 7-week win streak comes to an end. But the green on the screen for today, 300 points higher for the Dow, 0.7%. 39 points higher for the S&P, 0.6%. 99 points higher for the NASDAQ Composite, 0.4%. And the Russell 2000 closing out the day higher by 23 points or 1%.
All right, going back to the S&P 500, as Romain laid it out, I mean, we are finishing with gains here on this Friday. And you did have most names in the S&P 500 actually higher today. Vonnie, you've got 429 gaining ground, 73 to the downside, 1 unchanged.
And that's obviously reflected in the IMAP, where you see just green across the board, really, just consumer staples barely in the red, but consumer discretionary up there with utilities among the highest and best performers. That presumably after personal income and personal spending data came in better than forecast, that obviously would help the consumer discretionary stocks.
All right, so many gainers. Look at the green on that map. So many gainers to choose from. So get ready for Romain to interrupt me and add to my list. Having said that, I got to talk about EA, Electronic Arts, because that is your number one gainer in the S&P 500, NASDAQ 100. Kind of ran into that spot after we saw that headline cross initially with the Wall Street Journal story, but Bloomberg also matching the reporting. Electronic Arts up about 15% here at the close today. This as that story came out that this company is nearing a deal to go private. It would be a massive deal to go private. We're talking about maybe a $50 billion leveraged buyout. It would be the largest buyout of all time, LBO of all time. This is according to people familiar. Again, we're talking about Silver Lake said to be a part of that, Saudi's public investment fund. So we will see ultimately if that happens. But what are you thinking?
Well, when I looked up, anytime I see these deals, I always look to see where they're ranked. I was actually surprised that $50 billion is basically the threshold for the biggest buyout ever, potentially, obviously, if this actually comes to fruition. I mean, you would think there would have been something bigger, but it was really that TXU deal, I guess, way back when, before Tim was born.
I was thinking
that was like a $45 billion.
Well, adjusted for inflation.
I was thinking about is it KKR and Nabisco and
that was $31 billion. I mean, that's in real dollars. I mean, to Tim's point too, you have to adjust for inflation, but still. And then you had that $44 billion Twitter buyout, which is a deal.
All right, so EA definitely on my radar. A couple of chip names I just want to mention.
Take-Two was up also by about 5%.
There you go.
Yeah.
All right,
see, this is what happens, Vonnie.
Yeah.
10 minutes later, I get to the last one. All right, so chip names, let me go through it. We had Global Foundries and Intel both rallying. Global Foundries up about 8%, Intel up about 4.5%. This is after, again, the Journal, Wall Street Journal reported that the Trump administration is weighing a new plan to reduce U.S. reliance on chips made overseas. So we did see some movement in particular in those two names. I also want to mention PACCAR. It was top in the S&P 500, the NASDAQ 100 here at the close, up about 5.2%. It's a chip maker, and it rallied after President Trump announced new industry-specific tariffs that include a 25% levy on heavy trucks. And analysts say this company will benefit because it makes a lot of its trucks right here in the United States. U.S. production. There you go.
Can you get them at Costco?
I don't think so.
Well, that's where I'm going right now because it was the worst performer in the S&P 500, down 2.9% today. The company did report after the bell yesterday a mixed fourth quarter, including adjusted earnings per share and comp sales that excluded gas and FX that came in ahead of expectations. But analysts had high expectations. They said that the premium valuation versus its peers contributed to high expectations going into this print. Shares down today by about 2.9%. RH, they operate the restoration hardware chain of stores. Shares of furniture retailers, including RH, tumbled today. This after President Trump announced the U.S. will enact new tariffs on imported kitchen cabinets, bathroom vanities, and other home products next week. RH, with the outspoken CEO, has already declined 46% this year. That was through yesterday's close. And finally, Klarna. Kind of been a mixed road for IPOs of late, Romain. Klarna fell 3.8% today. Remember, it IPO'd a few weeks ago at about $40 a share. It fell below the IPO price for the first time. And increased competition, worries about interest rates. We spoke to the CFO of the buy now, pay later firm Affirm yesterday, who essentially told us the same thing that Max Levchin told us a few weeks ago, the CEO of Affirm.
Yeah.
Everything looks good for us out there in the landscape. We're not seeing any cracks in the consumer.
All right, let's check on yields real quickly here. A mixed bag, but generally speaking, yields did not go much of anywhere. You're looking at moves of basically about 1 basis point down on the 2-year, up on the longer end of the curve. We should point out on a weekly basis, though, we are pretty much higher across the curve as a lot of people now really starting to rethink whether we are indeed going to get Fed rate cuts. Carol?
All right, let's get to two of the most read stories in the past 8 hours on the Bloomberg. We're going to go to this one. I think both involves men around a table, but let's see if that's true.
My favorite.
There you go. White men. This is the headline. White men are making a comeback in American corporate boardrooms. It turns out corporate boards in the U.S. have never been more diverse. These same boards are now hiring white guys at the fastest clip in more than a decade. And what's interesting is, we talk about diversity. That's been certainly a priority, but that is kind of not as important maybe for companies. And what they're looking for, Tim, is people with experience. And that turns to be a lot of white men who've been in the workforce for a long time.
Interviews with directors and recruiters make clear that boards are seeking candidates with expertise as CEOs to help navigate economic and political turmoil, particularly tariffs. As far as numbers go, white men making up the majority of new directors added this year at S&P 500 companies. This is the first time going back to 2017. I think a change in the environment is fair to say has happened in recent months too.
They need people who've dealt with turmoil. I mean, this is a great story by our Jeff Green. I just want to point out.
But we talked a lot in the last few years about the pipeline and how you increase the pipeline for diverse candidates, and that obviously, if this is what's happening, that obviously hasn't happened over the last.
Does seem to be what's old is new again, but just like with cowboy boots, sometimes it's just not right. I mean, cowboy boots are in as well. It doesn't make them. It doesn't make them the right thing to be wearing. You know what I want to talk about? The Ryder Cup. You know why?
Oh.
Because Europe is leading 3-1.
Surprised me. I didn't know.
Yeah, 4 matches in, and Europe is 3 points. So that takes us away from the other conversation. Romain, are you?
I am curious. We're actually going to talk to Chad Mumm a little bit later. I mean, if you've seen Happy Gilmore 2, if you've seen, the reality show that's out there on Netflix here, he's responsible for that, really kind of putting golf into a pop culture moment. He actually started just for 2 days here a morning talk show. Called, I think it's called like Breakfast is Bethpage. It's kind of a partnership they're doing with NBCU down at Rockefeller Center. You can walk over there if you want, Carol. You have to get through security, but I don't know if they'll let you in. But
probably not.
I don't know if we're on the list.
No. Yeah. I just told them. I was like, you know who I am? They said no. And I walked around, with the blue. So.
What else you got for us?
Well, I'm just curious if you were walking around, are you planning on going out to Bethpage this weekend? Because President Trump just did. He was there for an hour, and of course, it was a bit of a test of his popularity as well. He tends to go to these sporting events, and he would have had some supporters on the teams as well. We know Bryson DeChambeau, for example, is a huge Trump supporter, but there'll be 22,000 people per day on that Long Island Railroad, so I hope none of you have to travel on that railroad this weekend.
I thought you guys were going to talk poker.
Yeah, me too. So anyway, Carol, it's lovely to see you, by the way, Carol. I mean, we made it through the week. Really appreciate it. We'll see how many days you make
Did you hear that? Bonnie brings everybody together.
Sorry.
You do. Bonnie, I'm so grateful you're here because I've been outnumbered. It's been a little rough.
Congratulations to that 24-year-old, though.
What?
The poker player.
All right, guys, we got to go. All right, please.
All right, guys, have a good and safe weekend. Whatever you might do. Golf, poker. Please. All right, Bonnie and Romain continuing there on The Close. Tim and I continuing on Bloomberg Business Week Daily. We will see you again. We'll all be here, same time, same place on Monday.
And our coverage does continue here on Bloomberg Television. A push ahead to next week, and a lot of concerns about the U.S. budget and a potential government shutdown. A conversation up ahead with S&P Global Ratings Chief Analytical Officer for Government. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romain Bostic here on an up day on a down week. The S&P 500 closing higher by about 0.6%. Most of the major indices also posting similar gains on the day, but all of the U.S. indices down this week. The S&P down for the first time in 4 weeks. You saw more significant declines in some of the more tech pockets of this market, including in the AI space and in the Bitcoin space. On the day and on the week, we saw a significant pullback there. Meanwhile, you did see a bid come into names like Global Foundries and Intel, actually two of the best performing tech stocks on the day and on the week. Electronic Arts getting a bid today, up 15% on the back of rumors that there could be a take-private deal in the works for the maker of video games. Meanwhile, tariffs still front and center for everyone, including the furniture retailer RH, and Klarna falling below its IPO price as some concerns right now about valuations in the fintech sector. And that brings us to our top story of the day, and quite frankly of the week. It's about the flow of money, because despite a muted week for financial markets, we should point out that the money still flowed everywhere: into gold, into bonds, into cash, and of course into stocks. Bank of America strategists say capital inflows into equity funds pushed past $88 billion globally in the past 2 weeks, the third highest two-week inflow ever. For the S&P, it's now gone 109 sessions without a drop of at least 2%, the longest such stretch in a year. The benchmark also on the verge of producing one of the longest runs above its 50-day moving average in the past 2 decades. Now, market concentration is still an issue, as Chris Cain and his team at Bloomberg Intelligence have pointed out. Geopolitical risk, it abounds too. And hedge fund manager David Einhorn warns that the trillion-dollar AI build-out that has fueled this almost 3-year bull market is so extreme that the eventual returns from AI are highly uncertain. But timing any short-term low is a fool's errand, one complicated by so many systematic investors being so long. Goldman trader Paolo Schiavone puts it like this: this is a carry-driven market, supported by liquidity, strong balance sheets, and positive impulses across fiscal, credit, and monetary policy. Valuation is a secondary concern. Flows, positioning, policy dominate. Joining us right now for our Factor Friday is Chris Cain of Bloomberg Intelligence to take a look at some of the factors that did move the market this week, Chris. And I know you're taking a closer look at what's been going on with regards to value.
Yeah, value. Yeah. You know, to set the stage, value basically has not worked. You know, the cheapest stocks have underperformed the most expensive stocks this year. It hasn't been too dramatic. I think some people are a little dramatic about it, but they have lagged. But I have 2 pieces of good news. Number one, cheap stocks are now way cheaper than expensive stocks. So on a price to sales basis, the expensive group is over 7 times sales. The cheap group is about 0.7 times sales. When you divide that, you get about 10.5%. So cheap stocks are trading at 10.5% the valuation of expensive stocks. That's a 16th percentile result since 2000. So very cheap. That's good news number one. Good news number two is that when cheap stocks are this cheap to expensive, at least historically, that has kicked off a really strong value run. Specifically, when it gets this cheap, the 4 long-short value returns are over 20%. So, you know, it's a bit of a hard timing to time based on valuations, but if you have a long-term perspective, we think value stocks are certainly interesting here.
But on that point, though, I mean, and I know, and I like the way you look back historically. So, I mean, there is some sort of credence to this. But then we always talk about this idea of the Russell outperforming. It does that for a few days or a few weeks, and then all of a sudden, nothing. It just kind of reverts back. And we had Steve Sosnick on earlier over at Interactive Brokers, and he's been somewhat muted on small caps. Basically just says he just not, at least right now, see the value in chasing them.
Sure. Yeah. Well, small caps trade has been very frustrating, right? But I'm talking about large caps within. Value within the large cap.
Within the large cap space,
right? So you could do factor investing within small caps or large caps. This is within large caps. But I think it's interesting to look at, like, when in history has cheap been this cheap? So, like, really 2 times stand out. After 2000, so after the dot-com bubble, you had expensive be very expensive. That kicked off a really strong value run in 2001 and 2002. And then back in the pandemic, 2020 and early 2021, you had similar relative valuation levels. Value actually did work in 2021 into 2022. So it has set up strong runs in the past, and we're basically here again now.
Yeah, I'm glad you point out that this is focused on large cap. It's kind of funny how your mind, when someone mentions value, you automatically think of sort of mid and small cap stocks. That's a good point. Now, you're also taking a look at some of the non-traditional factors that you think investors should be paying attention to.
Yeah, I've been having a lot of conversations with clients about EPS revisions. I mean, this is a factor that has worked for 15 years. It's worked really well this year. So specifically what we do is we look at what's called best estimates, so analyst estimates for the next quarter EPS, how those have changed over the last 3 months. Going long the high revisions, short to low revisions. That long-short factor is up 17% just year to date. Higher EPS revisions have dominated low over the last 15 years. It's not a traditional factor that most people look at, but we think it's very important, and it could continue to drive returns going forward.
Yeah, and particularly given that we're just about 2 to 3 weeks away from the start of the next earnings season. Chris Cain, always great intelligence from Chris Cain over at Bloomberg Intelligence here on this Factor Friday as we push ahead to next week and the economic states looming large as a potential shutdown of the U.S. government inches closer. We're going to discuss with Nora Wittstruck over at S&P Global Ratings when we come back after the break. This is The Close on Bloomberg. All right, a lot's going on in Washington, or maybe not enough is going on in Washington. A lot of folks right now looking ahead to Tuesday's impending government shutdown deadline. Economic risk looming large, as our next guest says, the longer non-essential employees are out of work, the more impact there could be on discretionary spending habits. Nora Wittstruck is the Chief Analytical Officer for Governments at S&P Global Ratings, and she joins us here in Studio 2. Hi, Nora.
Hi, good to see you.
I want to get something out of the way first.
Yes.
Is this at all have the potential to be a credit event?
So I'll answer that two ways.
Yeah.
The duration of a shutdown is always going to matter. So if it's 5 days, if it's 50 days, those are kind of two different things that we have to be looking at. And each shutdown could be different in terms of what's considered discretionary spending and what's considered mandatory spending. Historically, this has not been a credit event for state and local governments. And for the U.S. sovereign, it's not a credit event because P&I payments that are due on sovereign debt are considered mandatory spending.
Okay.
But this is a whole new ballgame with this federal administration. So everything's kind of on the table, and state and local governments are already reeling from policy uncertainty in a number of fronts.
Well, that's what I'm curious about. And we have on the screen there some of the longer government shutdowns. Of course, remember the longest ever also occurred under the same president, Trump, back in starting in late 2018.
Yep.
And you mentioned the idea is different, and we could be delicate about this, but you have so much has changed relative to where we were in 2018 in terms of how we view the federal government and the need of those workers. And we've already had the administration even threatening to just fire a bunch of people should they not strike a deal with the Democrats. If that situation comes true, that this isn't just a temporary furlough of a few non-essential people, that this ends up being absolutely a wholesale removal of certain people, even if just temporary, does that change how you evaluate it?
I think it really depends on what's going to happen with the economy. You know, the economy, our economists just came up with their newest forecast. They're still projecting annualized growth below 2%. I think our economists believe 2% is really status quo for the U.S. economy. So anytime it's below that, it can give pressures to, you know, the economy and the money that flows around in the economy and is a resource for most state and local governments in terms of their operating revenues. So, you know, I think that what's really the biggest concern is the duration and how many people are permanently out of work. Essential employees will go to work, they just won't get paid, and eventually will get back pay. So, you know, it's also a question of how much cash flow state and local governments can absorb in terms of that disruption.
We'll talk a little bit about that. I mean, the federal government will probably make good on whatever it needs to pay during that time period. But there is a big flow through into the state and local governments, not just the federal money, but of course, we kind of also forget that a lot of the workers who end up getting furloughed aren't in D.C. They're spread out around the country and in the communities out there. So how do they deal with that? Do they have optionality, the state and local governments?
In terms of supporting the people when they're out of work?
Or supporting themselves more than anything else.
I mean, I do think state and local governments are thinking about that. They're, you know, definitely have a playbook for this. As you mentioned, this is not the first rodeo in terms of a potential government shutdown. Typically, a government shutdown does pass at the very last minute by a continuing resolution. But I think it's all new. This is all new cheese for governments with all the other types of federal policy uncertainty. Luckily, many of them still have very high reserves. States on average have 13% in their rainy day funds to deal with these types of hiccups or disruptions that might occur. Local governments are benefactors of a pretty strong economy coming out of COVID, and so they have a lot of, you know, resources as well. But I really think if, you know, as the duration continues, as these people are either permanently laid off or, you know, coming back to work. That will all be a game time decision for us in terms of how we evaluate it.
I am curious about just the general timing of a shutdown. When it occurs kind of around what, at least traditionally here in the U.S., is kind of a big shopping period for consumers as we head into the holiday season in November. Does that matter more, having a shutdown, say, in October, November, December, relative to maybe having one in March or April?
I don't think it really matters, other than the fact that, right now, September 30th, the government's only funded through September 30th. So I think it's really a function of, obviously, the longer that continuing resolution or the 12 appropriation bills are in place for, that's better for the economy. It provides stability. But at the same time, I don't know if one is different than another.
I mean, what is generally now your house view over at S&P with regards to the health of our U.S. fiscal situation? And I'm talking a little bit more longer term, because we've been dealing with these shutdowns and these budget standoffs for, I don't know, it's a couple decades now, it seems. And it doesn't seem to be going away. And of course, famously, there was a famous downgrade some years back because of that risk.
Right.
Do we need to start talking about that again?
I think unfortunately, I'm not the sovereign analyst in my, so I can tell you what I know from what I've read the sovereign analysts write, and we talk on a regular basis. But I think the fiscal trajectory is a little uncertain at this point for the U.S. They are collecting a lot of tariff revenue, I think more than maybe they forecast. You heard Trump announce new tariffs yesterday. There's, other tariffs that could come into play over the longer term. But tariff revenue is something that I think the federal administration is definitely focused on, even if some of them are ruled illegal under IEEPA by the courts.
Have you actually taken the time to try to model in tariff impacts, or is it just you have?
They have looked at that in the forecast for the U.S. government. I think the uncertain part is we really just don't know yet. We don't have a long enough history with collection of those revenues to know where it might move the needle on the fiscal trajectory.
All right, Nora, I have to leave it there. I assume you're going to be busy next week. Maybe they sort something out over the weekend. All right, Nora, really great to have you here.
Thank you.
Nora Wittstruck is the Chief Analytical Officer for Government over at S&P Global Ratings. And just a reminder, we will, of course, have full coverage here on Bloomberg with regards to the budget process. And, of course, that will start at 5 p.m. tonight, Washington time, with our team over at Balance of Power. Meanwhile, here on The Close, we keep an eye on the markets, and we look back to the week that was. And it was actually, despite being a down week for the broader markets, it was a relatively strong week for some of the, old school tech companies. Intel, that's a weekly basis you're looking at, up 20%. And of course, all of that has to be dependent on this idea of the continued investment coming into that company from NVIDIA, from the government, now maybe potentially from other names as well, including Apple, if you believe some of those news reports. Halliburton also having a phenomenal week, up about 12%. In fact, most of the names in the oil services sector rally, as we did see a bump up this week in oil prices, largely because of some concerns about geopolitics, what's going on in Ukraine and what's going on, of course, over the skies in Europe. And then keep an eye on Bitcoin, a down week, a rare down week, if you will, for IBIT, which had been rallying for the past 5 weeks, a bit of a pullback as some people start to question the wisdom and trajectory of that Treasury strategy. And CarMax, a phenomenal drop this week, down 23%. When we talk about the health of the consumer and we talk about what Diane Swonk had to say earlier about the K-shaped nature of this economy, CarMax really seems to be indicative of some of those concerns. When we come back after the break, we are going to continue that conversation, and we're going to do it through the lens of what the Fed does next. A conversation with former Kansas City Fed President Thomas Hoenig. He joins us after the break, right here on Bloomberg. All right, we're following a developing story out of Washington surrounding Fed Governor Lisa Cook. Cook is asking the Supreme Court to remain at her post at the Fed, with her legal team calling the Trump administration's allegations to remove her flimsy. Now, let's unpack some of the critical legal questions at the center of this story. Greg Stohr, who covers the Supreme Court for us here at Bloomberg, joins us right now. And Greg, I know we're still awaiting to hear something from the Supreme Court on this issue. What do we know right now in terms of what Cook has said, what the Trump administration has said, and what the Supreme Court may say?
Well, first of all the briefs are in now. The Trump administration filed its last brief earlier today. So now we're just waiting for the Supreme Court. And as you said it, the question is whether Donald Trump can remove Lisa Cook temporarily while this fight over alleged mortgage fraud goes forward in court. And if the court says, yes, Donald Trump can fire her, even temporarily, a huge victory for the president in his effort to exert more influence over the Fed. Of course, he's been trying for many months to get the Fed to move more quickly to lower interest rates.
I am curious, Greg, if for some reason the Supreme Court comes out and denies the request by the Trump administration, what happens then? Is this just over?
It's not over. The case will continue to go forward at a lower court. So a federal district judge said, no, you can't fire Lisa Cook, at least right now, Mr. President. And the administration has appealed that. So if the Supreme Court says, no, you can't fire her temporarily, that appeal goes forward. They fight over it at the appeals court level. But it may be many, many months, even more than a year, before the case gets back up to the Supreme Court.
All right, Greg Stohr, who covers all things Supreme Court for us, and we remain on watch for a potential decision, a potential announcement out of the Supreme Court on the status of Lisa Cook's tenure at the Federal Reserve. We want to continue that conversation now with former Kansas City Fed President Thomas Hoenig, now a distinguished senior fellow at the Mercatus Center at George Mason University. And Thomas, I do want to get your thoughts on the economy in a second, but I also want to get your thoughts on what Lisa Cook had to say, at least in her formal brief with the Supreme Court. Very heavy rhetoric here. In her words, basically saying that chaos would ensue if she were allowed to be removed, saying that this would, in her words, sound the death knell for central bank independence. Now, I understand her and her lawyers have to go in there and make the most extreme case possible, but does her characterization, does that strike you as a possibility?
Well, I think it's a bit of a stretch. I think personally that she would be, I think there would be a kind of a moment's pause in the markets to kind of sort things out. But whether it means the end of Federal Reserve independence as they think about it, I think that's probably not necessarily the case. I think if he is successful and then he starts going after Powell for finding reasons to do him, then I think that would shake up the markets a lot more. But I think Lisa is a member of the board. She's not the final decision by any means. There would still be a strong board left, so I don't know that it would be the end. I think what they're arguing, and what I saw with a friend of the court briefing by former Fed chairs and Treasury secretaries, is that it would send a signal that the Fed is going to be compromised in terms of independence, and I think that's maybe an overstatement.
I am curious. I mean, at your time in the Fed, and I think we may have asked you this before on your previous appearances, but did you ever feel any direct pressure, external pressure? I don't mean just someone criticizing what you said or what your decision was, but I mean any sort of meaningful pressure to lean one way or the other when it comes to policy?
Well, of course you do. Different groups, different individuals, different people in Congress, they will argue with you. They will say, you're making a mistake and this sort of thing. But that's to be expected. I don't see that as unusual. And I would remind people that President Trump isn't the first president to put pressure on the Federal Reserve to lower interest rates. I mean, you've got Harry Truman, you've got President Johnson, you've got President Nixon. So this isn't unusual. What is unusual is if they do fire Lisa, then that will be somewhat of a first of actual firing of a member of the FOMC. Others have been pressured to resign, and they have. Mm-hmm. So this is not out of so far out of bounds that you can't believe it's possible. It is possible.
Yeah. I mean, outside the realm of whatever political motivations there are, there has been a more legitimate intellectual debate about the Fed's function, its transparency, and more importantly, this idea of what the benchmark rate should be or what should drive it. And Lori Logan sort of threw a log on that fire yesterday, talking about replacing it with something that's a little bit, I guess, more market-oriented. And it seems like Beth Hammack has made similar comments as well. Do you think this is time now to have a serious conversation about whether the current benchmark, the federal funds rate as we know it today, just needs to be changed?
Well, I think that's a legitimate concern, but whether it's the Fed funds rate or something else, I think the bigger issue is how much discretion should the central bank have in its policy actions. For example, QE was an enormous change. That is, quantitative easing, the massive printing of money in a recovering economy was really quite a significant change. in the how the Federal Reserve operates. It made that a tool. That's pretty dramatic. So how about how they go about that? Whether they should have full independence to do major changes in the policy mechanism? Those are questions I think. Yeah, it's time to hear about that. And it's around independence. It's about how much discretion the central bank should have when the actual money and credit of the United States is really the responsibility of the Congress. So it's a legitimate concern.
It's a legitimate concern. There's also a lot of concerns about the inflation target, the 2%-ish inflation target. And we got another PCE report today. We're still camped out near that 3% level and that core PCE number. We've been there for eons, it almost seems like at this point. Do we need to rethink that target?
No, I think what we need, well, let me put it this way. I think what they're doing right now with the 3% target, and it continues to hold over almost for the last year, is it looks like they're accepting that new target as the target as 3%, not 2%. But remember what the Federal Reserve Act says. The Federal Reserve Act says they should pursue price stability. And price stability is not 2% inflation. It's closer, much closer to no inflation. And so, yeah, there needs to be a debate over what the target should be, but not whether it should be higher, but whether they have the right target at 2%. You know, that was an arbitrary number. It wasn't based on any kind of research or anything like that. And I think that is really a concern because 2% or 3% inflation over a decade or so is an enormous devaluation of your purchasing power of your dollar. And those are legitimate concerns of the public, and I think should be concerns of the administration as well, or of the Congress.
Based on your read of the recent economic data and kind of what we know about some of the policies coming out of non-monetary policies coming out of Washington, do you see inflation coming down meaningfully anytime soon?
I really don't. I think, you know, if you look at the numbers, I mean, the second quarter numbers on GDP were marked up pretty dramatically. The consumer is still very strong right now. There is a lot of stimulus. I know they're talking about the tariffs as maybe constraining the economy, and it might. But remember, the tariffs bring in $360 billion a year. The debt itself, the new debt, the deficit is near $2 trillion. So that's not going to draw that problem down anywhere quickly. And so I think that's where you get new inflationary pressures for the future that they're ignoring. The Federal Reserve, out of caution or out of fear, whatever it is not pointing out that fiscal policy is driving inflation. And the Federal Reserve is being put in a position of having to monetize that debt if the Congress doesn't begin to address its spending issues. And I think that's a big issue for the Congress and for the United States going forward from here.
All right, Thomas, always appreciate your insights. Have a wonderful weekend.
Sure.
Former Kansas City Fed President Thomas Hoenig, they are now at the Mercatus Center down there in Washington. All right, when we come back, all eyes on the Ryder Cup. In fact, I think most eyes are on it right now. I hope you're watching us and not them. Golf is having a bit of a moment, a pop culture moment, and the Ryder Cup is riding that wave. Chad Mumm joins us after the break. He's the executive producer of Netflix's Full Swing and the founder of Pro Shop. That conversation after the break. This is Bloomberg. All right, we're talking golf. It's an individual sport, except when it's not. The Ryder Cup. Teeing off in New York, and it's primed to generate about $200 million in economic impact, according to the PGA of America. The golf event also bringing about the debut of Breakfast at Bethpage, a new live pregame show hosted by Colin Jost. You see him there. And here in town with us is one of the brains behind that program, Chad Mumm. He's the president of Pro Shop, also the producer of Netflix's Full Swing and co-producer of Happy Gilmore 2. Great to see you, Chad.
Great to be here.
You know, we were talking earlier today about how golf is kind of having this pop culture moment. And it's kind of funny. A lot of that kind of links back to you and Pro Shop in a lot of ways. I mean,
guilty.
Yeah, and the Ryder Cup is fun. I mean, you know, golf traditionally is a relatively staid sport. And the Ryder Cup is sort of one of those moments where that staidness just kind of goes out the window.
It's unlike anything else in the sport. You know, it feels like being at an SEC rivalry football game or a European soccer game. That atmosphere is going to be crazy anyway, but then you mix it with golf, which is traditionally a gentlemanly sport. It's one of a kind.
Yeah, well, gentlemanly, depending on what course you play.
I
play some very non-gentlemanly courses. But to your point, though, also the idea of just making it a little bit more engaging and making it a little bit more fun. We reference this Breakfast at Bethpage, just kind of a special program you guys have been doing with Colin Jost. And I haven't had a chance to watch it, but what gave you the idea to do that?
Yeah, it was actually the PGA of America who puts on the Ryder Cup had this idea of trying to just do something fun. We're in New York, kind of the comedy capital of the world. Let's do something a little playful, sort of inspired by College Game Day. The atmosphere is already so good. There's already so many people waiting on that first tee. All the fans kind of in anticipation. So yeah, we're live every morning from 6 to 8 a.m. So it's an early show on Peacock. You can watch it on the World feed, and
I assume I can just watch it anytime.
You can definitely watch it anytime, so you don't have to get up. But Colin's hilarious. It's a lot of fun. We're co-producing that with Omaha, Peyton Manning's company. It's really good at it. We got tons of celebrity guests. It's a really fun way to kind of get yourself through those 2 hours. You got to wait until those first tee shots.
You've worked with Omaha before.
It's our first time working with Omaha.
Yeah, really? Okay, cool. So that's got to be fun, right?
It's been great. Yeah.
And we also mentioned you that Pro Shop was a co-producer on Happy Gilmore 2.
Yes.
Which of course took the world by storm.
Did.
And that had to have been cool too, right? I mean,
that was amazing. Yeah. Adam is one of a kind. I grew up watching that movie. It's kind of what got me into golf, and to be able to play a role on the second one. We actually spent a lot of time here in New York. We filmed most of the movie out in New Jersey, and brought a ton of cameos. If you've seen the film, it's full of cameos. And a ton of pro golfers show up, and obviously it did really well. So we're happy about that too.
And then we mentioned Full Swing, I guess they call it a reality show, for lack of a better phrase. It gets to this idea though, like who are you going for with these things that you're either producing or co-producing? Are you going for that hardcore golfer, or are you just going for maybe even somebody who doesn't even normally would watch golf?
That's exactly what we're trying to do. I mean, it really all started for me with Full Swing, which we've produced 3 seasons of Full Swing, so that show's been on the air for several years. And the whole idea was, how do you take something that, maybe on the outside people don't really think is full of a lot of drama, but escalate the stakes of it and really bring people inside those characters. And Full Swing was produced for a mass general audience, and I think I'm the biggest golf nerd there is, but it even surprised me how popular that show became. And we are in this moment of rising culture, rising relevance and culture for golf, and you see it not just in entertainment. Full Swing, Happy Gilmore 2, obviously Breakfast at Bethpage. You're seeing it. It's one of the fastest growing categories on YouTube. You see this huge growth of youth interest in golf and golf consumption. Even one of the top players of the Ryder Cup this week, American superstar Bryson DeChambeau, one of the most popular YouTubers in the sports space. So we feel like golf is really in an amazing place and really newly relevant in pop culture in the last 5 years.
Does it still revolve around the individuals? You mentioned Bryson and a few other people. I mean, I go back to the last time golf had this wave, and obviously that was on Tiger. But he was like a singular character, like unlike any other. But I mean, it drew a lot of people to the sport. Are people being drawn to the sport because of a Bryson or another player, or is it more the holistic nature of what we're seeing on the screen?
Yeah, I think what we're in the middle of right now is a slightly different version of a golf boom. It's much more grassroots, it's much more kind of consumer-led, kind of ground up. And if you look back, golf's had these cycles of popularity, and I mean, honestly, going all the way back to Francis Ouimet in 1918 and Bobby Jones, and then, Arnold Palmer in that era, and Tiger Woods, of course, as you mentioned. But, this boom was not so much driven by a singular superstar on the professional level, but just a bunch of effort from the golf industry to make the game more accessible through things like simulator golf, obviously Top Golf, the rise of content like golf influencers and creators have become extremely popular. I also think, hopefully Full Swing and some of these projects have helped kind of pour gas on it. But, to me, it's celebrities, athletes, musicians, actors, they've always played golf. Now they're posting about it on Instagram. So if you're, if you're a young kid, you see LeBron James in the last 4 months becoming obsessed with golf. It's like golf has lost that stigma that it's had for the last probably 60 years of just not being for the average person. And I think that's put golf in a really different place than it's ever been before.
Yeah, absolutely. You're seeing a lot more celebrities out there. And some of them are really good, too.
Some of them are really
Curry,
good.
I mean,
Steph Curry's, legit player.
I know, legit. And so I won't even ask you which team you're rooting for this weekend.
I'm a proud American, so, I bleed red, white, and blue this weekend.
All right, USA. Chad Mumm, the co-founder and president of Pro Shop. We'll be back in a moment. This is Bloomberg.
To be able to wisely invest my money and not kind of just spend it all, I think and then be able to invest in a team as well too. So, I mean, just with the record label, I have a label manager, radio pluggers, marketing, managers I work with as well, agents. So it's a whole business. So I think having that background knowledge really helped me take my career to the next level.
And that was John Summit on the business behind being a world-famous DJ. I had that conversation with him just a few days ago. And today I actually had a chance to catch up with another world-famous DJ, Grammy-nominated music producer and entrepreneur, Steve Aoki. He's actually launching his own venture platform, Aoki Labs, and it's focused on well-being and innovation. We talked about that, and we talked about, well, how DJing has moved from, well, the back room to, you see it there, right out in front. Take a listen.
I've been investing for like close to 15 years now, and it's all kind of accumulated to this point where now I have structure, I have a team, and now we can do proper due diligence instead of me just jumping into stuff on my own, but doing due diligence and bringing in other people to invest with me. And
when you say jumping into it on your own, in the past, it was just what you would just enter into things just based on your own gut, or what?
Yeah, that, and just like the level of access I had, I was able to get into, you know, like things like SpaceX, or like early on Spotify, early with Uber, Pinterest, things like that actually did really well for me. Just having that kind of level of access with the you know, the kinds of people that we're meeting, now we can bring it to, you know, this group of investors and a team to actually do the due diligence. I had a smaller team. It was just me and my music managers that were involved, but now this is a more elaborate, thoughtful team that's going through, you know, every company that we're looking into. And we closed our Fund 1, which is great, and we have incredible companies that we've been able to allocate investments into, and it's very exciting.
Are most of the opportunities people coming and pitching you and your people, or are you seeking them out?
A little bit of both. A little bit of both. Some of the companies I've known for a while, like Nora, is a company that we invested into. I've known them for almost 10 years, since the very beginning of the company when they started in like 2016. So a lot of it is stuff that I've already do on the daily. You know, try out and see if it works for me. And since our fund is focused on health and longevity, that's something that I have a very big interest in. So I like to try those things, whether it's like the analyzing your blood and finding out your biological age. We have a couple investments into companies like that, to things that work for me on the road, you know, like Nora, or things that work that I see just, you know, being online and seeing how well companies are doing in the entertainment sector, of how they're relating to their community and how they're doing B2C wise. I'd love to follow that too, as well. So
on the longevity side, and I noticed that you have been very involved in that for some time. I am curious about, with the types of companies that you're interested in, and more importantly, maybe the types of companies that you're using to do your own analysis for yourself here. Do you see that maybe scaling up to a point where just everyday people will have access to these? Because some of those tests can be pretty expensive to get and to repeat.
Yeah, so for example, this one company that we invest into, I met with the CEO, he came to the house, spent some time with him. It's a company called Superpower, and they do blood work analysis on 100 biomarkers, and it's only $200 to do that. At one point, it was $100,000 to do that, so it was nearly impossible for anyone to do that unless you're extremely rich. And now people can do that, anyone can do that. And this is a great way to start understanding, you know, your whole body, you know, and then understanding what you need to do to improve in certain areas that you might be deficient in, or some areas that you might have problems in. So I think that's something that when I did it myself and I got the information, I immediately told my close friends and family, I'm like, hey, everyone needs to do this. This is great to get a base understanding of your body and where you stand. And if I'm sharing it with the close friends and family, I mean, I think everyone else should have that same level of access too, and it's you know, it's affordable for people to get that.
In addition to the interest we've seen in longevity, sort of another, I guess, different side of the coin is obviously everything that's been going on with artificial intelligence, which of course can fold into the healthcare space as well. I am curious as to how deep you've invested in that space right now.
Into AI companies, we're looking into it very, very thoughtfully. We did invest into a company called Music.ai that's an AI company that focuses on mixing and mastering music. I'm a producer, I'm a musician, so having an AI source that can do all the mixing and mastering at the levels that I need, that's not impeding on my creative, the sourcing of the song. I'm I'm happy for that. That's going to be really helpful for a lot of producers. I think a lot of producers are going to use that for that purpose.
And that was part of my conversation with Grammy-nominated music producer and entrepreneur Steve Aoki. As we wrap up our coverage here on The Close, here on this Friday afternoon, let's push ahead to what markets will have their eye on next week. Geopolitics still in focus at the White House, but so too are earnings. We're expected to get results out of Jefferies, out of Carnival, and Nike. Keep an eye on that. Also, we should point out that Tuesday night brings us the potential for a U.S. government shutdown. We'll keep an eye on that and have full coverage of all of the proceedings leading up to that. We're going to get auto sales and ISM manufacturing data on Wednesday. Thursday brings us the release of production and delivery data out of Tesla. And Friday is going to be a big one. The U.S. jobs report for September will be released, assuming the government is still open. Stick around. Balance of Power is up next.